Have you been wandering around the internet trying to figure out what the heck CPI is and why it's become so important to the stock market? And frankly, how do you handle all of that? Then you have come to the right place. Today we're going to talk a little bit about how inflation and these CPI numbers are hitting the stock market, both in the good and bad manners, and what to expect in the coming months. And most importantly, how can we trade it? Guys, my name is Kunal Desai. I'm the head trader at Bulls on Wall Street. I have been trading stocks since 2008 and taught over 60 trading boot camps that are 60 days long. That's 3,600 days of live classes with students all over the world going over these things that we talk about on the YouTubes every single day. From day trading to swing trading to even longer terms type of trading. I'm the man you go to when you want to learn this from a live teacher. So let's talk about CPI. These CPI numbers come out once a month. It is a measure of core inflation. As you guys have probably heard, the inflation numbers is what's mainly causing these huge fluctuations in the stock market. The gist of how all this works is when inflation gets high, the Federal Reserve has to raise interest rates. So if you look back at this last year, especially since the summer, the Fed has been raising interest rates anywhere from 50 to 1 basis point every single month, and that is tightening the credit situation. So why is that bad for the markets, and how does that impact with the CPI? So when interest rates are low, there's really nowhere else to put the money except the stock market. So if you look at the chart of the NASDAQ for the last decade, as inflation has been low and interest rates have been low, the stock market has been on this hyper fuel of growth. You are seeing, right, companies like Apple, Google, Tesla going on thousands of % of return. But one of the main reasons beyond them being awesome companies is that there's nowhere to put your money. See, when interest rates were at zero after the financial crisis, what had to happen was, since you can't put your money in a bank, a CD, a bond, right? You can't earn really any interest anywhere. People, funds, pensions, everybody had a mad dash into the good old-fashioned stock market because there was nowhere else to get returns. But now that cycle is starting to change. As you can see from this summer, the interest rates have started to rise. And we knew that even before they started to rise, that they were coming. So that has coincided with the stock market starting to tumble, with the anticipation that there are other places to put money and get a return. Then people start to sell stocks and the market starts to crater. Beyond that, because of the low interest rates for all of these years, it has made huge bubbles in certain sectors like real estate and tech stocks. And so now we're starting to see the unwinding in all of these things. So when the Fed had announced 1 year ago that they're going to start to raise the interest rates, you started to see in November all these tech companies start to drop. So if you look at UPST, Affirm, Squarespace, PayPal, they all started to drop well in advance of even our confirmed bear market, which started in January. So these interest rates are impacting the market in a huge manner. Beyond that, the inflation numbers have been coming in so big, every single month you're seeing 8%, 9%, 7%. And so that is also sending the stock market tumbling because the anticipation of rising rates even more. Low rates, good for the market. high rates, the market gets under pressure. So what we're seeing right now, though, is something that's really interesting. See, inflation has been high for so long that the expectation is that at some point these inflation numbers should be coming down. But in September, the expectation of what the inflation rate was different. The numbers came in hotter than what was to be expected. So we ended up seeing a big drop in the market. So if you look at the last inflation numbers on September 13th, they came in so hot that the market had a big gap down, and then we actually followed through the whole day. It was one of the biggest down days of the year, and that's saying a lot considering we've been in a really nasty bear market. So if you actually look, prior to September 13th, the market had actually been going on a string of big up days where people were getting really excited that maybe these inflation numbers would start to come down. But lo and behold, on the 13th, we got a surprise, and now we have been ticking down ever since without really even a bounce in sight. So our next inflation number will be coming up really, really soon. The things to watch out for is the surprise. So whatever the expectation is, whether it's 8 or 9 or 10 or 7, it's the surprise that matters. Meaning, if we have an expectation of inflation coming in at 8 and the market comes in and the number comes out at 7, it's a surprise to the downside, meaning inflation got a little bit better. That would send the market skying. On the other side of things, if we have an expectation of 8 and the number comes in at 9 or 10 or even 8.2, historically in this year, every time that's happened, the market has started careening down to the downside. Now, when that specific pattern starts to change, then we can start to see market conditions start to improve. So the whole point is we want to see improvement if you're a bull and bullish on the market, because an improvement in inflation, especially if it's a surprise, will catch people off guard and send that market higher, and vice versa to the downside. So guys, hopefully that helps as a little bit of primer on CPI and inflation and interest rates. Let me know if you have any questions. Guys, I teach day trading live 4 nights a week in my 60-day boot camp. You guys can get access to all the strategies that I've been using since 2008 to profit from the markets. I've taught thousands of students, and I teach them live in a mentorship capacity, which I believe is frankly the best way to learn how to trade stocks. Whether you're new or experienced, if you want to supercharge your trading and get started in this game, I'm the guy you come to. Check out bullsonwallstreet.com for more information on my 60-day bootcamp. And guys, let me know if you like this video and have any comments. Take care.